So if you're a self-employed person, you're going to have to report the income and expense from your self-employed business on your Form 1040 every year. And so that's done with a Schedule C and a couple of other schedules and worksheets, and ultimately it's included with your Form 1040, and you pay federal income tax and self-employment tax on your net earnings. So to start, who needs to file Schedule C? So again, it's for self-employed persons. So sole proprietorships, right? The most simple form of business. If you don't set up a legal entity, you just want to go out there and start selling a product or a service just in your own name, you would report that income and expense on a Schedule C. Schedule C is also used for single member LLCs that are disregarded for tax purposes. So in this example, we have John Q, taxpayer. He formed an LLC in the state of Florida, and an LLC that is owned 100% by a sole owner is a disregarded entity for federal tax purposes. So again, it's treated for tax purposes as if he was just running a sole proprietorship and didn't even have the legal entity. Now, if you have an LLC, cases where you wouldn't use this schedule. So the LLC can file an election to be taxed as an S or a C Corp. If John had made one of those elections, then the LLC gets its own tax return. He wouldn't use Schedule C. Also, if you have an LLC with more than one owner, right? So if John is in business with Jane, they're a 50-50 partnership. It's no longer a disregarded entity, so the LLC needs to file a Form 1065 partnership return each year. And John and Jane would get a Schedule K1, and they would report their allocation of the income on their Form 1040. But again, they wouldn't use Schedule C. So, and start with this example. So John Q, he's got his LLC there, John Q Taxpayer LLC. The top here is pretty straightforward, right? John's information, the tax ID number of the LLC, address, the accounting method. Most sole proprietorships they're just under the cash basis method. So generally, you're just select cash. And the questions here about material participation, in most cases, yes. I mean, if you're a sole proprietor, you're going to be the one doing all the work, right? So you're going to materially participate in the operations of the business, okay? So part 1 and 2, income. So again, pretty straightforward. Under the cash method, report the total gross receipts you had for the tax year, and then start entering your expenses down here. A couple of items to highlight. Car and truck expenses. So if you use your car or truck, generally you're going to want to deduct the mileage. So you track how many miles you drive using your personal vehicle during the year, and then you multiply that number by the mileage reimbursement rate for the year. So if we jump down here, excuse me, you see the vehicle information in part 4. You can see here where you enter information about your vehicle, so the day you started using it in the business, how many business miles you drove, and some more questions about the vehicle. John only used his vehicle for 80 miles, right? So let's say he took one trip to a client and back. Round trip was 40 miles, or 80 miles round trip, 40 each way. And then 80 miles is multiplied by the reimbursement rate for the year. So that arrives at $46. Couple other items. Let's see. So supplies, travel expenses, insurance, all pretty straightforward. Legal and professional fees, $500 to get the entity set up and started. Line 30 is for the home office expenses. And again, there's another worksheet and form. So form 8829 down here, business use of home. So if he has a home office, he's self-employed again, so he's working from home. Enter information about the home office, square footage of the office versus the total of the house, all the indirect expenses, and ultimately the allocation that's for business use. I have another video about the home office deduction that goes into a little more detail. So please check out that video if you have some more questions on the home office expense. Okay, but if we jump back up here to Schedule C, so we've covered all the expenses. So now he's got his bottom line, net income or loss in some cases for his self-employed business. He's at $10,268. So what do we do with that number? So the $10,268, like I said at the start, is the earnings are subject to both federal income taxes and self-employment taxes, right? So he's got to compute the amount of self-employment tax on those earnings. That's Schedule SE, so that should also be included with your return. Complete Section A, as the instructions stipulate here. So you can compute the amount of self-employment tax as well as the amount that's deductible on your return, right? Because if you're self-employed, you're paying both pieces, the employer and the employee portion. And so as the employer also, you are allowed a tax deduction for that portion of the employer match for the FICA and the Medicare. Okay. So let's see what else we got in here. Depreciate. That's for the home office again. He's depreciating the home office portion of the property. Okay, so a couple of elections. Let's go down here. So a few elections I always recommend doing. After the tangible property regulations were passed a number of years ago, the IRS has given us a little leeway here as to what you can deduct or capitalize. So if you're purchasing assets, for your business, and they have a useful life of more than a year, you're kind of supposed to capitalize them and depreciate them over the useful life. But because that kind of got too cumbersome and there was a lot of gray area about what should be capitalized and depreciated, they put these regs in that says, look, I mean, if it's under a certain amount, just deduct the whole thing and make this election, right? So the section 1.263 election, the de minimis safe harbor, we're making that. We're just saying, look, all the expenses that we've got up here in Schedule C, if anything in here was the purchase of what might be considered an asset, so it's not just an expense. If it's an asset purchase, but it's under a certain amount, we're deducting it all. We're not going to capitalize and depreciate that. So I think it's always good to have that election in there just to kind of cover you and make sure that, if the IRS ever challenges it and they start looking at the expenses, you can show them, look, I made the election to expense everything currently. So I didn't have to capitalize small asset purchases and deduct them. And because this is an initial year return for him as well, we're also electing to deduct any startup or organizational costs. Normally, you're supposed to capitalize any startup or organizational costs. So, if you paid legal fees and things like this to get the entity launched, you should capitalize those startup costs and amortize them. But if it's under $5,000, you are allowed to just deduct everything currently. Just make sure that you add this election statement to your return, and that should also cover you. Okay. So if we jump back up. Okay, so the 10,268 number eventually gets reported on Schedule 1 here, right? So Schedule 1, business income or loss, there's that 10,268. The adjustments to income, that's the deductible portion of the self-employment tax, right? So the 726 is the piece that John is allowed to deduct from this 268 number and arriving at ultimately what his federal taxable income might be. And let's see, what else do we need to cover? The tax, there's the self-employment tax. So this number and the 726 number from Schedule 1 above, those can be traced to that Schedule SE worksheet. And let's see what else we have in here that we would need to include. So we got the home office depreciation, the 4562, the election statements, auto expense worksheet. So again, that's just a worksheet that's normally generated when you prepare your return using some sort of tax preparation software. That doesn't get sent to the IRS, but it's part of the return package just for your record. So John, so he's got a Honda Accord. He started using it in this new business on Jan 1, and those are his business miles, right? And there's your mileage rate for the 2019 tax year. So the mileage reimbursement rate was 58 cents per mile. So that's how we arrive at its $46 deduction. And then new for post the tax reform in 2017, we have the QBI deduction. So John's got his QBI or loss amount there that's computed above. And so he gets an additional deduction on page 1 of his 1040 here, right? So line 10, qualified business income deduction and arriving at his taxable income. I have another video on QBI for self-employment purposes, but also for S corps and partnerships. So go check it out if you want to learn a little bit more about the QBI deduction for qualified businesses. So I think that covers it. Thank you for watching the video, and if you have any questions about Schedule C or any of these other schedules or forms, please leave a comment below. Happy to help where I can, and of course always appreciate the likes and on the video and the new subscribers, and I hope to see you again. Thanks.